everyone stares at the S&P 500 or like the euro. Like that's where the real game is played.
Right.
We watch these flashing red and green numbers, the frantic news tickers, and we think we're actually seeing the market. But the truth is those markets are really just the puppets.
Yeah, they're the symptoms.
Exactly. And today we are looking at the strings. We are stepping into the actual engine room of global wealth to decode this hidden 60-minute window that basically dictates exactly what the rest of the market is going to do.
It's a profound perspective shift, honestly. When you stop looking at all the distractions and you start looking at the foundational mechanics, I mean, the entire financial landscape completely changes shape.
It really does. So welcome to the deep dive, everyone. Consider this your masterclass in market structure. Today, our mission is to unpack the foundational methodologies of the Inner Circle Trader, or ICT, and we're shining a massive spotlight on Treasury Bond futures. And I want to say this directly to you listening. Whether you're an aspiring day trader, a Forex enthusiast, or just intensely curious about how macroeconomics actually function on a minute-by-minute basis, you have to understand bonds.
Absolutely.
Even if you never execute a single bond trade in your entire life, they are the secret algorithm driving the currencies and the equities that you actually do care about.
But, before we break down those mechanics, we do need to establish a pretty rigid professional baseline from the source material.
Right, the disclaimer.
Yeah. Everything we explore today regarding these ICT concepts, it should be viewed strictly through the lens of paper trading. So, simulated, risk-free analysis.
Just watching the charts.
Exactly. This is not financial advice. It's an analytical framework for reading the footprints that institutional algorithms leave behind in the market.
A very necessary boundary.
Yeah.
So let's just step right into that engine room. We are talking about the 30-year Treasury Bond futures contract.
Yes.
On a charting platform, you're going to be typing in the symbol ZB. We're looking at the Chicago Board of Trade, specifically focusing on the core New York's session, which is 8:20 a.m. to 3:00 p.m.
New York time. Yeah.
New York time, right. But my immediate question is, why bonds? I mean, if I want to understand market momentum, why not just analyze the S&P 500 where all the retail volume and media attention is focused?
Well, the sources explicitly highlight the 30-year bond market as the least manipulated of all the major asset classes.
Really? Less than stocks?
Oh, by far. I mean, the equity markets like the S&P, they're heavily influenced by corporate buybacks, individual stock earnings, retail sentiment is just noisy.
Right.
The 30-year bond, however, is this massive, highly liquid market that's driven almost entirely by institutional hedging, sovereign wealth funds, and global interest rates.
So it's simply too heavy to be shoved around by like random market noise or individual speculators.
Precisely. Because of that sheer mass, when the bond market actually begins to trend, it tends to stay in that trend. The artificial tomfoolery, as the text actually calls it, is minimized.
Tomfoolery, I like that.
Yeah, and that makes it the absolute perfect, unfiltered barometer for tracking what smart institutional money is actually doing beneath the surface.
Okay, that makes sense. It's like the quiet back room where the real truth is told while the casino floor is going crazy.
That's a great way to look at it.
But knowing that the ZB contract is the ultimate indicator, that's really only half the battle. If we want to catch the smart money operating, we have to know exactly when to look. Yeah. And the sources emphasize a very specific, critical 1-hour window.
Right. We are zeroing in on the opening range concept for bonds, specifically the block of price action that occurs between 8:00 a.m. and 9:90 a.m. New York time.
Why that specific hour, though? I mean, the equity markets don't even open until 9:30 a.m.
Because that hour is the crucible. It captures the pre-market positioning right before the 8:30 a.m. macroeconomic data drop. So things like inflation reports or unemployment numbers.
Oh, I see.
Yeah, and it captures the institutional front-running before the 9:30 a.m. stock market open. Because of that massive concentrated influx of capital, this single 8 a.m. to 9 a.m. range usually dictates the ultimate high or low for the entire daily session.
Wait, let me make sure I'm wrapping my head around the gravity of that.
Sure.
If I just map out the highest price and the lowest price that the bond hits between 8 and 9 a.m., one of those two lines is highly likely to be the absolute ceiling or the absolute floor for the rest of the day.
Very often, yes. It basically sets the boundaries of the battlefield. But, how the market interacts with those boundaries, that is where the real strategy lies.
Right. And to understand that interaction, we really need to translate some of the core ICT jargon here, because the text relies heavily on terms like liquidity pools and stop trends happening around this opening range.
We should definitely ground this.
Yeah, let's do that. Because I've often heard liquidity compared to, like, a crowded waiting room of orders.
Yeah.
But that feels a little too passive. What do we think of institutional liquidity? More like crossing a rapid river.
Okay, I'm tracking.
If a massive bank has a billion-dollar order to move across the market, they're too heavy to just jump across, right? They need stepping stones. And the pending stop-loss orders of regular retail traders, those are those stepping stones.
That is a much more accurate mechanical visualization, honestly, because institutions cannot simply execute a massive buy order at market price.
They'd wreck their own trade.
Exactly. If they do, they will instantly spike the price against themselves and ruin their own entry. They need an equal and opposite force to absorb their size. Basically, they need sellers to buy from.
So they have to actively hunt for those stepping stones, which I guess brings us to the stop run.
Yes. Let's walk through the scenario. So between 8 a.m. and 9 a.m., an opening range is established. Retail traders see that range, and they place their stop-loss orders just below the low of it, thinking it's this safe support level.
Right, classic textbook trading.
Exactly.
Yeah.
But institutions, they see that accumulation of sell orders. That's a liquidity pool. So what happens? The algorithm intentionally pushes the price down, breaking right below that 8 a.m. low.
And to the retail trader, that looks like a massive bearish breakout. So panic sets in.
Yep. The retail traders are stopped out, their sell orders are triggered, and right at that exact moment, the institution steps in, absorbs all of those sell orders with their massive buy order, and immediately reverses the price in the opposite direction.
Wow.
They ran the stops to engineer the liquidity they needed to actually fuel their real move higher.
That is surgically ruthless.
It's business.
Yeah, true. So once they've triggered those traps, swept the liquidity, and reversed the price, where does the market actually go? How do we know where this, engineered move ends up?
Well, the sources point to two specific destinations: order blocks and fair value gaps.
Let's break those down. What is an order block in this context?
So an order block is essentially the origin point of institutional accumulation. Structurally on a chart, a bullish order block is the very last down-close candle right before a massive impulsive upward move.
Okay.
And a bearish order block is just the opposite. It's the last up-closed candle before a violent drop.
So it's not just like a random support line you draw on a chart. It is the literal footprint showing where the giant stepped into the market.
Exactly. And when the price eventually returns to that specific candle, it often acts as a highly sensitive reaction zone, because the institutions are inherently defending the average price of their accumulated positions.
Got it. And what about fair value gaps? Because I'm looking at charts where the price just violently teleports from one level to another, leaving these massive empty blank spaces between the wicks of the candles. Is that random, or is that part of this whole institutional framework?
Yeah.
Oh, it is entirely by design. A fair value gap, or FVG, as traders call it, it occurs when price is delivered so aggressively in one direction that the market actually fails to offer a fair exchange between buyers and sellers.
It's like it skips over prices.
Right. It leaves a literal vacuum and inefficiency in the price delivery algorithm. And because the market is designed to be efficient, it acts as a magnetic draw. Eventually, the price will naturally retrace to fill in that empty space and kind of balance the books before continuing its true trend.
Okay, this is all incredibly logical in hindsight, but let's stress test this for a trader looking at a live chart.
Sure.
Say we're watching that 8 to 9 a.m. window. The price suddenly tanks below the opening range low. How does a trader know in real time if that drop is just a trap, like a stop run to sweep those stepping stones? Or if the market is actually just crashing and they should get out of the way?
That is the pivotal question right there. And this is where reading volume divergence becomes your primary filter. The sources outline a very specific validation tactic for this.
Okay, let's hear it.
Let's say it is 9:15 a.m. The price breaks below that 8 a.m. low. It looks terrifying on the chart. But you immediately check your volume data. If the trading volume on that new lower drop is significantly lighter than the massive volume you saw during the 8 to 9 a.m. hour,
All right.
that is a divergence.
Wait, but isn't volume data often like delayed or lagging? How does a trader act on that without getting caught in the whipsaw?
Well, it's not about the absolute number. It is about measuring relative effort versus result.
Effort versus result.
Exactly. The price is making a lower low, right?
Mhm.
That's the result. But the volume is lower, meaning that's the effort. The market is basically expending less energy to push the price down.
Oh, wow.
Yeah, it tells you there is no sustained institutional selling pressure behind the drop. It's a hollow move, engineered purely to trigger stops. So when you see that lack of effort at a new low, it's your signal that the real expansion is about to be higher.
Effort versus result. That totally reframes how to look at an indicator. Now, I can hear the listener thinking, this is fascinating, but my portfolio is entirely currencies. I trade the euro, the pound, the yen. Why am I spending my morning analyzing the 30-year bond?
Right, the connection.
Yeah, we have to connect the dots here because these markets are inextricably linked by this invisible macroeconomic thread.
They really are. The sources establish a fundamental law for this methodology. Interest rates are the tumblers in a lock for global markets. They're the underlying mechanism that permits or denies movement in foreign exchange and equities.
Okay, so how do the tumblers actually turn? Let's walk through the mechanics of that lock.
It operates on an inverse relationship. So
Yeah.
when the bond market is aggressively rallying, meaning the actual price of the ZB contract is going up,
Mm.
U.S. interest rates or yields are inherently decreasing.
Bond price goes up, interest rates go down. They move in completely opposite directions.
Correct. And when U.S. interest rates decrease, the U.S. dollar suddenly becomes much less attractive to global investors who are always, always hunting for yield.
Makes sense.
So this puts massive downward pressure on the dollar, and when the dollar weakens, the lock is turned. Foreign currencies like the euro, the British pound, the Aussie dollar, they are now permitted to aggressively rally.
This is a massive takeaway. You're saying that to accurately predict an explosive clean breakout in the euro, staring at a chart of the euro is actually secondary.
Completely secondary.
The true leading indicator is that 8 a.m. Treasury Bond opening range.
Exactly. If you are exclusively analyzing the euro, you are effectively trading blind. You're looking at the symptom, not the cause. The bond market is the engine room. The currencies are just the cars being pulled by the train.
That is wild. So what does this multi-asset analysis look like in practice? Like, what is the actual daily procedure for you, the listener?
Well, the routine outlined in the text is pretty much non-negotiable. Every single day, you need to pull up a 15-minute time frame on your charting software.
Okay, 15-minute chart.
Right. You monitor the ZB, the 30-year bond, but you must overlay it or compare it side by side with the U.S. dollar index, the 10-year Treasury note, and the 5-year Treasury note.
So we're looking to see if they're all correlating, they're all singing the same tune.
Actually, we are hunting for the exact moment they stop singing the same tune. We are looking for divergence across the yield curve.
Oh, I see.
Here's the specific trigger to watch for between 8 and 8:30 a.m. If the general market is trending down, the 5-year, the 10-year, and the 30-year notes should all theoretically be making lower lows together.
Right.
But what if the 5-year and the 10-year drop to a new low while the 30-year bond completely refuses to drop with them?
Why would that happen? Like, what does that crack in the correlation actually mean mechanically?
It comes down to who is trading what. The 5-year and 10-year notes, they're highly sensitive to immediate short-term shifts in Federal Reserve policy or just daily news.
Short-term noise.
Yeah. But the 30-year bind represents massive long-term institutional outlook. So if the 30-year refuses to make a lower low while the shorter-term notes do, it means massive institutional capital is actively anchoring the long end of the curve. Smart money has basically stepped in and started quietly accumulating.
It's the footprint of the giant again. They are absorbing all the selling pressure on the 30-year, refusing to let it fall further.
Exactly. And when you spot that divergence across the three bond markets early in the New York session, that is your ultimate green light. It confirms that the stop run is over, the accumulation is complete, and a massive correlated expansion is imminent across all asset classes.
That really gives you the fundamental why behind the technical win. It's a beautifully complete system. But, the mentor in the source material also gives a very stern warning about specific environments where this system just falls apart.
The danger zones.
Yeah, danger zones where we should not be hunting for order blocks or divergences at all.
Right. You must entirely remove yourself from the market during major macroeconomic news releases. We are talking about Federal Open Market Committee rate decisions, the FOMC or the non-farm payroll reports.
But a lot of traders actually look forward to those events because that's when the most volatility hits. Why walk away when the market is finally moving fast?
Because that volatility is a chaotic vacuum. During those high-impact events, the major institutional players, the entities that actually provide the liquidity, they temporarily pull their orders off the books to protect themselves.
Wow. So the market just empties out.
The market becomes incredibly thin. With no stepping stones to slow things down, the price algorithms will violently teleport to wherever the nearest pockets of liquidity are.
Jeez.
It will aggressively spike up to wipe out the early sellers, instantly collapse to wipe out the early buyers, and then completely reset before a true trend even emerges.
That's not trading at that point. It's just gambling inside a random number generator. Stepping aside protects your capital and your psychology, which actually brings us to a really interesting pivot point. We have the procedure. We know to isolate the 8 to 9 a.m. hour. We know how to measure effort versus result with volume. And we know to hunt for divergence across the yield curve. But what happens when you execute this brilliant, complex analysis? You sit down at your desk, and the market just does absolutely nothing. It just drifts sideways.
You've hit on the ultimate filter there. I mean, all the technical edge in the world is utterly useless if a trader lacks the psychological discipline to navigate boredom.
Because listening to this breakdown, it makes day trading sound like a high-stakes action movie, right? Stop runs, magnetic gaps, institutional front-running. But the daily reality for a trader is often incredibly, painfully monotonous.
It is, and the source material heavily emphasizes the concept of consolidation days. A consolidation day is characterized by the bond market being trapped in an incredibly narrow range.
How narrow?
The text defines a tight opening range in bonds as just 12 ticks or less.
12 ticks. That is practically microscopic. It's barely breathing.
And when the 30-year bond is barely breathing, which, by the way, frequently happens ahead of major U.S. holidays or in the days preceding a massive bond auction, it places a stranglehold on volatility for the entire financial ecosystem. If the bond market is choked, the euro, the yen, the equity indices, they all stall out. The tumblers in the lock refuse to turn.
So what does this actually mean for you sitting at your screen? Let's talk about the emotional cycle here. I imagine a novice trader, someone the text might call an action hound, they see that tight 12-tick range, but they feel compelled to participate.
Right, they have to be in the market.
Yeah, they start forcing trades, buying the top of that tiny range, selling the bottom, just slowly bleeding out their account to fees and tiny losses. They get frustrated, they cuss at the screen.
That is the exact mechanism of how retail traders destroy their own mental and financial capital. They try to impose their will on a market that is fundamentally resting. The mentor's advice here requires a complete paradigm shift. Professionals do not resent consolidation. Professionals deeply respect and actively welcome consolidation.
Why welcome the boredom, though? Why would you celebrate a market that, refuses to pay you today?
Because it is a law of market mechanics. Small ranges precede large ranges. A market cannot trend indefinitely. It has to pause to build energy.
So it's coiling up.
Exactly. A consolidation day is essentially a massive billboard indicating that a highly profitable opportunity is being engineered behind the scenes.
It's like the tide receding dramatically before a tsunami.
Yeah.
You don't paddle out and try to surf the receding tide. You sit on the beach and prepare your gear for the wave.
That's spot on. The professional trader uses this quiet time strategically. They step back to a higher time frame chart. They map out the field.
Right.
They look at those tight, choppy ranges and ask, where are the retail stop losses accumulating right now?
Looking for the stepping stones.
Yes. They identify the liquidity pools building up above the overnight highs and below the overnight lows, knowing the algorithms will eventually target them. They do the analytical homework so they are entirely prepared for the inevitable explosive expansion that always breaks out of the quiet.
That reframes everything. It's about utilizing rule-based ideas to master fear and greed. If your 8 a.m. bond analysis tells you the market is in heavy consolidation, you intentionally downshift your expectations. You might aim for a highly conservative scalp, like just taking a quick piece of the inner range, and then you have the discipline to literally turn your charting software off.
You walk away.
Yeah.
You let the market wear down the emotional, untrained traders. You let them exhaust themselves arm wrestling a sideways market.
Wow.
Because by preserving your mental capital, you ensure you have the clarity and confidence to execute flawlessly when the clean days arrive. Those obvious, easy trending days that always follow a period of deep compression.
Yeah.
If you can master the boredom, you have mastered yourself.
That is a phenomenal place to pull this all together. Let's recap this journey. Today, We stepped out of the noise and into the structural foundation of the markets.
Yeah.
We unpacked why the 30-year Treasury Bond futures, the ZB, is the heavyweight indicator for smart money. We decoded the critical 8 a.m. to 9 a.m. New York opening range, learning how institutions use stop runs to mine liquidity like stepping stones.
Real engine room.
Exactly. We explored how to filter those traps by measuring relative volume, so effort versus result. We mapped out a rigid daily routine comparing the 5, 10, and 30-year notes to spot institutional accumulation through yield curve divergence, effectively using bonds as the key to unlock currency breakouts. And finally, we highlighted the ultimate psychological edge, treating consolidation not as an annoyance, but as the mandatory building block for the next major trend.
Understanding these concepts really allows you to see the invisible architecture beneath the price action. And, I want to leave you with a final analytical scenario to mull over. We've established that the bond market acts as the leading engine for currencies. But consider this. Tomorrow, you open your charts. You see the bond market aggressively breaking out, trending hard with massive volume divergence.
Right, looking good.
But you look over at your euro or pound charts, and they are entirely ignoring the bonds. They are trapped in a tight 12-tick consolidation.
So the gears in the engine room are turning violently, but the wheels on the car aren't moving at all.
When you see that exact disconnect, who is lying?
Oh,
Are the currency algorithms just temporarily trapping retail traders, building up a massive liquidity pool before a violent sudden snap to catch up to the bonds? Or is the 30-year bond market quietly pricing in a massive systemic macroeconomic shift that the rest of the world hasn't recognized yet?
wow.
The next time you sit down to analyze your charts, don't just passively accept what the price is doing. Start critically asking yourself what the price is intentionally refusing to do. The divergence between effort and result is where the true story is told.
What it is refusing to do. That is a really powerful lens to view the market through. Listen, thank you so much for joining us on this deep dive. Keep analyzing those 8 a.m. opening ranges. Guard your mental capital during those tight consolidations, and always look for the footprints of the giant. We will catch you on the next one.